You think I have nothing to offer but pain? Only I know you love pain. Pain reminds you the joy you felt was real.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, April 22nd, 2022. A lot of fun to say. S&P 500 is sitting at 4308. I'm David Zarling. I'm here with Ian Toprope McMillan and Delta Dan Gorkuber. Great to have both of you guys on this, as well as having you in the office this week to give a great presentation to our clients. Much appreciated. Thank you.
Yeah, it's great to be there.
It's fun to be around. Yeah.
Minus the Monday morning snow.
Yeah, that's a thing. I don't know. I mean,
it is a thing. It's a thing out there in the northern Midwest.
That's a thing, and I just, we
What
appear
you guys
to
do. I get it.
We save it for when you arrive. Like, it's kind of fun It's kind of fun to watch you walk outdoors, and you're kind of like vibrating as you go across the parking lot.
Yeah,
it's a great.
I was not built for cold weather.
I don't know, man. I mean, I just love that you keep your house at nursing home temps. I mean, I'm impressed, but again,
I know people do think 72 is aggressive, but it
is actually. If you're out there listening, you can go ahead, go to the at Adaptive Twitter, and you tell us what you keep your house temp at when it's cold out, and maybe Ian's in the norm. Maybe Dan and I are outside the norm. That 72 could be. I mean, I feel like I should be in my swim trunks. 72, but whatever. So
definitely gonna have to have a conversation with my wife on that one.
Oh, she would love it.
Yes.
Yeah. So
no, it was good to see. It was good to see clients. It was very good.
It's always good. It's always good to communicate our process, hone our process, and what I mean by that is putting together countless hours of information and presenting it in a way that hits home is also galvanizing for the theses that are out there and that are developing. And so it doesn't hurt us. It's nothing but a good thing for everybody. And so there's a lot to highlight for, this week, especially because of the bigger picture as well. I know in the Lunch and Learn, we talked about how many markets have been sideways for many days, but that doesn't mean we're out of the woods. And here we have a week like this week where we continue.
Some markets have been sideways for 15 years.
Yeah, some markets have been sideways for 15 years. Yeah, emerging markets, you name it. A lot of international spots, Europe, 15 years. Yeah. And what does the industry say? You should be holding that for your clients. And we couldn't disagree with that more. And same thing, we don't have to buy and hold things, including what if U.S. stocks do something similar? We don't have to hold U.S. stocks. And so what are we seeing? There's obviously market weakness when we look domestically this week.
Mm-hmm. Mm-hmm.
Let's jump into it. Let's talk about S&P 500. Let's talk about the things you guys covered this week in the Lunch and Learn, whether it's the 60-40 portfolio or Dan covering commodities. I'll let you guys take it from here.
So I covered the 60-40 portfolio, kind of talked about the history of it. It's kind of broad acceptance, just mind-numbing acceptance because it's worked so well for the last decade. Now, the first decade, 2000, 2009, not that great. But over the last decade, it's done so well. And yet we've gotten here to 2022, and it's just had a horrible start to the year. Really fixed income. And what I try to express to clients is that it is kind of ironic to see here Q1, I guess we're in Q2 now, but people start to panic over the fixed income story when bonds have been in a downtrend for, well over a year.
Yeah, let's take a chance on that, or a chance to talk about the fact that bonds have already been in a downtrend, similar to Netflix this week.
Woo.
It's not like that was
no
out of the blue.
Yeah.
Netflix had a recent major price move to the downside after earnings release. As our listeners know, we could care less about the earnings. And I don't mean to be mean about that. It's about the price reaction to the earnings. Like, yeah, we care about the earnings, but not the way people think. It's just the price reaction to the earnings. And here we have Netflix releasing earnings, and nobody wants to own that stock. Now, it hasn't gone to zero, but it had a pretty big price correction. But it was already a downtrend before that. It's not a mystery.
Yeah, it started in its downtrend in November, right? And it had the big gap down in December, which I'm assuming was also earnings. And it was down 28% before that gap down. And before this most recent one, it was 52% off its highs. Hadn't gone anywhere for 3 months of this island consolidation. And then we see, leading into its most recent earnings report, another big double-digit gap down.
So what you're describing, Ian, and we were having a conversation about this on Wednesday evening after it took place. Let's go ahead and plant a flag and lay claim on the name of a pattern price behavior that we should be addressing in this particular situation, right? You talked about the gap down, price consolidate a little bit, following another gap down. What do we got? What are we calling this?
So I would call it an island continuation.
Absolutely. Because would be the opposite of an island reversal, where you see a gap down, price consolidates, and then gaps back up, leaving an island of price behind it. And I know I'm kind of getting in the weeds here. Usually we save stuff like this for the extended, but it fits perfectly with talking about Netflix here. You're saying gap down, consolidation, gap down, left an island, and it continued. I think it's great.
And it hasn't stopped.
Right. So we want that included in the CMT curriculum because it's happened. Here's a real world example. Island continuation pattern. Name it, claim it. We should be teaching it. It's great. Not great for Netflix shareholders per se, but it's something worth observing. Pivoting back to the 60-40 portfolio, 60% stocks, 40% bonds. As you mentioned, Ian, it's not like what bonds have done the past few months are a surprise because we've been in a downtrend. One of the things we highlighted in the Lunch and Learn is when you look at long-term price behavior. So going back years, we talked about 15 years for emerging markets. If you drew a line or marked February and March of 2021 on all of these charts, that's when a lot of this correction has begun.
Mm-hmm.
And the 60-40 portfolio, great over the past 10 years, but isn't it really something probably born out of the fact that the current generation of investors have known nothing but rising bond prices?
It's been a huge tailwind that I think most investors, most other professionals in this industry have taken for granted.
Yeah, for sure.
And so, so where are you going to go? Let's say this turns into a multi-year, multi-decade trend, higher in rates. Where are you going to go? And clearly commodities has been one of those areas in energy last year and so far into 2022. And that's kind of where Dan was able to show his expertise.
For sure. Absolutely. Right. Because there's a missing number from 60-40. Dan, you want to talk about that?
Yeah, that was really kind of the larger themes that we wanted to, highlight. This Lunch and Learn was not only just talk about the commodities in general and what's been going on the last, 2-3 years and obviously more year to date, but just allowing our, anybody at the Lunch and Learn, et cetera, who's been listening that, hey, commodity exposure is not something that we see, allocated to across the board with maybe other advisors specific to maybe even from an index level, right? Like the S&P 500, how much direct commodity exposure does a buy and hold investor in the S&P 500 really have?
What's the answer?
Really none.
Yeah, no, it isn't. It is.
I mean, none. Again, outside of energy, maybe some materials, right?
Yeah, maybe a little there. Yep.
But that's banking on the fact that the companies involved with the commodities have the same move as the commodities.
Right.
But even that, I know Ian, you highlighted what's the weight of, let's say, something like energy in the S&P 500.
I mean, 4% at this time. I mean, now I'm sure that the financial planning team could speak more directly to this, but when statements come over, and I talk to prospects or new clients, they're not coming over because their advisor's let's just say they're not coming over because their advisor is too overweight commodities for them. You see some of these holdings that come in, you understand that a lot of people out there have just ridden it up and ridden it back all the way back down.
Yeah. Allocated towards growth, having some of that, 35 to 40% bond exposure. And it's hard when bonds are also moving directionally that's the same way as stocks. And on the flip side, no commodity exposure. And to Dan's point, how detrimental could that be to an account if it doesn't have any commodity exposure? So we'll see. I mean, time will tell. And I know Kevin and I have talked about this in the past, that it's great to get information the next day. Do these trends in commodities have to continue? Because, right, let's be honest, this week, the things that had been leading, energy and metals and mining, like, I don't want to sit here and pretend like, oh, yeah, everything's just hunky-dory. Everything's great. When
we were able to hide out in those areas for a while, and even those might be coming to it.
Right. And those got hit this week,
your
along
veggies,
with, right.
Yeah, your moves, the natural resource stuff, so energy, right? Clients, we talked about this at the Lunch and Learn. Clients are going to be very familiar that we've kind of just been huddled up under this small shelter of energy and natural resources and commodities, trying to, wait out the storm, so to speak, that's going on in the rest of the market. And
I love that picture.
Seems like the roof might have just blown off our shelter.
Yeah. So what Ian's describing there and I know we get a lot of great feedback from those who listen. What he's describing is metals and mining, energy, commodities was this narrow roof that we could hide under while everything else is correcting. But now we're seeing those areas correct as well. And Ian's calling that the roof coming off. Fair summary, Ian?
Yeah. So, I mean, do you see this period, right? The final flush, you usually see the correlations, everything hit, one to the downside, everything gets.
And correlations crushed. Go to one. And what Ian's describing there is in markets, there can be a lot of periods where there's two-way. And what that means is just like on a highway, you got some cars going north, you got some cars going south. And that would be perfectly normal in markets. Also perfectly normal is when there's southbound accident and they have to divert everybody and everybody's got to turn around and go north for a little bit. And all of a sudden the correlation is one. Everything is heading in the same direction. In this case, actually, it's an accident northbound. Things are moving south. A lot of things. Yeah. Prices moving downwards.
Latin America that had held up.
Yeah.
A lot of these areas.
Well, and even bringing, it's happening like we've been talking, it's happening at logical levels, in specific,
it is,
terms to commodities and some of the stuff, we've been hiding out in is that will kind of maybe tease it for the later extended portion, but, we don't get to be surprised from a level.
A lot of failures out there, a lot of failed breakouts.
Yeah. And so it's worth paying attention to these relationships. Where the strength has been. Last week, we talked about needles in the haystack. The last needles in the haystack were metals and mining, energy from an equity perspective. Yes, some international bonds, definitely not much there. Commodities were a safe haven. So we'll see how this continues to play out. But there's definitely relationships that show us that risk is increased. And so our main objective, right, and what we're doing is to manage that risk. So reducing exposure. What are some relationships that we see that give us clues on kind of the risk off or risk on type of environment that we're in?
Well, you're seeing, like more specific to probably this week and really the month to some degree, real estate and staples in terms of sectors,
That's
domestic
exactly what I was
sectors,
going to
right?
say.
Kind of,
Staples continue to hit new relative highs, small cap staples. Like you said, people piling into REITs.
And those are typically risk off type behavior moves to be moving into those areas.
And I say to remind people, and in fact, I spoke with a former small cap fund manager. He was an analyst at the fund yesterday. And they talked about, going through these environments as a small cap growth. And I asked him, I was like, did you have a cash mandate? And he said, yeah, 5%. So remember, there are fund managers out there who have to
be invested,
stay long, right? And even if this stuff eventually fails, even if they feel that this stuff, Staples, Coca-Cola's, your Altria's, is going to fail, you will see assets move into those stocks kind of at the 11th hour, because these portfolio managers are trying to dampen the ensuing drawdown that they feel is coming, if that makes sense.
Oh, exactly.
And we've talked about that a little bit. They did, I think it was the Lord Abbott guys, did a great presentation on this at the symposium in 2019. They ran a growth fund and talked about how they kind of had this 8-10% sleeve that they could move into staples and then still kind of be within their growth boundaries, if that makes sense.
Yeah, no, if you've got a mandate where you got to be 95% invested, your main job in environments like this is to find the things that are going down less. That's it.
Yep.
So I get it. I mean, I totally get it to be managing a mutual fund or the assets that are in there. And thankfully, we don't have the same mandate here. We can hold all sorts of cash, all the cash we want to hold.
Such a relief.
Right. We can exit positions. Metals and mining and energy have been great for our clients, and they've been hit this week. And there are reasons why there are a sell button. So that's an option as well. So we're seeing
even like we can run relative strength against cash.
Yeah. Well, one thing I found really interesting this week, or was late last week, is we saw tech represented by XLK break down versus money market on a point and figure chart. And so that's a kind of a big deal because that's a bigger time frame. And so you're seeing some pretty big weakness out there. Whether it continues or not, we don't know. But here we've talked about risk off areas seeing demand. So places like real estate, staples, you could argue utilities, at the same time, weakness underneath the surface. I think about this yesterday, even 82% of stocks moving to the downside. If we get something like that again today, some would call that a type of downward breath thrust. Mm-hmm. We'll see. Yeah. We'll see. And with correlations moving towards 1, these are why we have the ability to hit the sell button and move to cash. Because cash is a position too. So why not? I'm thankful we don't have a 95% mandate. That would be very hard.
Yeah, and new highs, new lows have continued to dominate. Now, Wednesday was a decent day for new highs. No pun intended. But
I understand what you did
there. The rest of the days, I mean, we continue to just see new 52-week lows outpacing new 52-week highs. And a lot of those highs from Wednesday were just staples and utilities anyways.
Right. You weren't actually talking about the cannabis or alternative harvest sectors or industries, which are now going out at relative lows. Yeah, correct.
Relative lows. And I even think MJ going, you could see
new relative
all-time
lows.
Closing lows.
Yeah.
All-time closing lows today. I mean, it's great stories. Like a lot of names out there. Amazing stories.
Yeah.
So they're not.
Well, they're not.
Roku, an amazing story. Well, Netflix. Back below where it was. I mean, Roku is.
There's a lot like that.
500. It's gone from 500 to 95.
Well, let's talk about some of that. So you talked Roku. Netflix. You talk about a stock like Zoom. I mean, there's all these. I want to be careful on like the size of these. And where I'm going with this is these are some smaller capped names, smaller capitalization names. And one of the things we brought up in the Lunch and Learn was just what we're seeing from a market capitalization standpoint. Where are we at there? What is market capitalization and where are we at in that scenario? Because some of these smaller names are falling off, right? We're seeing, like Ian said, Roku. We're seeing Netflix. Go ahead, Ian. Sorry.
So market capitalization, just, a formula for how quote unquote big a company is. Current share price times outstanding shares traded. So when you hear people say, oh, Apple is $1 trillion company, that's what they're referring to, their market cap.
Mm-hmm.
And the Apples, the Microsofts continue to hold up. Microsoft now back below 284. But if those truly finally fall, right, and they finally got to Google yesterday, Google that had held up so well, down another 4% today. That's a lot. That is a lot of index weighting that is now. It hasn't been a headwind. Hasn't been a tailwind, but it looks like it's going to be the final.
So as we move up the capitalization chain, right? So if you think of like, a big pizza pie, delicious New York pizza, which I plan on having next week when we come to the CMT symposium. But when you look at that pie, your biggest pieces are Microsoft and Apple. And some of these other names that we dropped in there are small, skinny. It's a miscut piece of pizza pie with Microsoft and Apple that are outsized. And those two together around 11%. And they're really the final one. Like they're the final. If they can hold up, things might be okay. But we know that if they break down, it's a problem. So what are we seeing out of Microsoft and Apple?
Apple, you can't say it's broken down yet.
No, it's sideways. It's been, same place sideways. It was back in December, so we're
early December.
4 months, 5 months.
Microsoft, yes, like I said a few minutes ago, it's back below 284. We've done this countless times this year, and they have saved it. So we'll see there. Amazon, still sideways, still above, barely. Still above this 280, 2890, whatever you want to call it, kind of in there.
But these are the final pieces. So we've talked about broad indices holding up okay on an absolute basis. And what I mean by that is S&P 500, NASDAQ 100, moving to anywhere from 250 to 360 days sideways. So they're holding up ish, even though they've corrected, but it's also through time. Other areas broadly have corrected more than that and further in time. And underneath the surface, we've had major corrections in things like ARC Innovation, IPOs. We talked about marijuana. Like there's a fair amount of things underneath the surface. So either we get a broadening out and things like start to stabilize and things can move higher, or these final pieces, things like Microsoft and Apple, break down and the broad indices go with it. Because, let's be honest, 11% of a index is a lot for two companies. I think it's the highest it's ever been.
Yeah. There was a good graphic on that during the Lunch and Learn.
Yeah. I think it was the top 10 market capped companies in the S&P 500 were about 30% of the index. Think about that. There's 500 stocks, and 10 of them are a third of the whole index.
That's wild.
Yeah.
And it's great, right? And this is what we told. It's awesome when it's a boost.
Yeah.
And I think we're going to find out how much it could suck when all of that momentum works.
Yeah, because it's momentum in both directions, right? You can have upside momentum, you can have downside momentum. And when these big things move higher, if it covers a lot of sins. I mean, it's great.
Energy up percent.
Right.
And these other areas that don't matter, we never get, let's say, a bear market, but it's just the stocks that move the market aren't moving.
Yeah, no, exactly. And so Dan, we kind of pivoted quickly off of the 60-40. There's no number for commodities. Anything you want to touch base on regarding commodities before I start asking about where we are seeing strength and kind of opening it up a little bit? Anything you want to touch base on there?
Nothing probably in this portion. I think in the extended we'll maybe get into some like the ratios that we're seeing some pretty important inflection points coming up that could be given some clues. We'll see how they want to react to it, whether it's distribution, healthy consolidation, but I'll maybe tease that for the extended portion. How does that sound?
Sounds great.
All right.
Sounds great. So the more recent low, when we look at something like the S&P 500 or the NASDAQ 100, was about mid-March. Mid-March is where we saw some of these broad indices have a low. We haven't reached back down to those levels yet, but these times and prices are where we can identify where there's strength. Are there areas that you guys are looking at and paying attention to because they remain above their March lows or even their April highs? I know you guys talked about real estate and you talked about staples, very defensive type sectors. Anything
those
else
areas, energy's still
right.
And energy's been hit. Energy's been in a pretty solid uptrend until the last 2 days. So, but other than that, what stands out to me strength wise? That's few and far between, Dave.
Yeah, I know. And that's information.
Yes, it's been these places, but now you take, Moo.
Okay.
It's still going to be, it's still going to be when I run the rankings this weekend, still going to be highly ranked in the relative strength rankings. But in the last 2 sessions, you've had about 5 weeks of returns wiped out.
Right.
Yesterday, you had 3 weeks. So, there's not a lot out there that I think going into the weekend, I'm going to be super excited about as of right now.
Well, yeah. And it's all happening broadly below 200-day moving averages. So we have strength in energy and metals and mining. Like you said, they're going to still show up on the rankings. But when you look at their relative chart, they're up against a place where you would expect them to have this weakness. And this is all happening in a market cycle where we're seeing stocks and bonds down and commodities up, which is what we would call stage 5 of a business cycle. And so the evidence continues to build that this is some type of significant top. Now, what will change that is typically out of the bottom comes things like tech. And so if we could see Apple and Microsoft hold up and we could see a return to growth and a return to tech discretionary consumer services, which consumer services have just been
the worst sector they're the only sector. Now, this was as of a couple of days ago, but they were the only sector that was negative over the last year.
Yeah.
Now, you had a couple that were only up 1 or 2, like industrials, I think was only up 1 or 2%. But communication services was down like 12%. Right. Horrible. Mm-hmm. And then Netflix happens and it makes it even worse. And then people are shocked. Right. And then I'm shocked that they're shocked.
Yeah. Are we relabeling FANG?
The worst. And they've got Facebook in there. Horrible stocks.
Yeah. Yeah. Facebook. Oof.
Another new absolute lows for Facebook. Right. Looks like going into the weekend, unless they fix this.
And
another name well below its pre-COVID highs.
Yep. And sitting at 5 days away from a price reaction that could give us another island continuation. So we'll see.
Yeah, you're right. Earnings coming up, I guess.
Next week.
Oh, for both of them.
Yeah, the 27th.
And so we'll be looking for price reaction there. But again, if Facebook moves down from here, we're in the similar situation as Netflix. It's not a surprise. Like, it's not a surprise if we see anywhere from a week to 6 months, Facebook down by 141 because the downtrend is in place. I know that we're not going to try to catch that falling knife. We'll let somebody else figure that out. But these are some major companies that are major stocks that are in corrective mode that during the beginning phase of a bull market, you would see doing well. And that's not what we're seeing. So the evidence continues to build that there's some type of top going on. But
well, I mean, you even take the recent breakouts, like you take a Boston Scientific.
Okay.
Like that's pretty close to an A+ setup in my book.
Mm-hmm.
Maybe RSI could have been above 70.
Well, it's an absolute and relative breakout from a price perspective.
On good volume. And to see these things just get walloped and not pan out to the upside, it's so unhealthy.
Right. And so what would we like to see for this market to turn around? Have the large cap names like Microsoft and Apple, which they've been doing their job. I mean, they've held things up pretty well here compared to everything else. See a return to software, see a return to these more risk-on type areas, emerging markets, frontier markets, things like that. But until we see that, the thesis that some type of distribution and market topping process is in play, that's not what we're calling for. We're just saying that thesis continues to be confirmed. And until it's not, until it's refuted and new information becomes available where we're seeing tech, discretionary, consumer services, industrials perform well and pull us out of this, and we see large cap names participate. Now, the other themes could still take place. We could have this market correction move on. We could move sideways for forever, and metals and mining and energy continue to work. But right now, they've hit areas where we would expect resistance to take place. So definitely a caution warranted type of market. So with that, before we jump into the extended portion of the podcast, anything the two of you would like to highlight before we do that for our clients?
No, just great to see all the clients. Great to see everyone at the office this week. Had a really fun time.
Yeah, they miss you already, Ian. Dan, how about you?
Yeah, no, I'd echo Ian's comments. It was nice to see clients this week, see other teammates, team members, build some more relationships. It's always a positive vibe with that situation. So happy to be back here. And yeah, thanks for having me back this week.
Both of you guys did an awesome job during the presentation and all week long. So it's much appreciated, and our clients appreciate it. So with that, we'll sign off. We'll be back again in a week. Hope you stay on for the extended portion.
Have a great weekend, everyone.
Thank you, everybody.
All right, heading into the extended portion of the podcast, I'll open it up, kind of leave it to you guys where you want to start with this. I mean, there's all sorts of things we can cover, from weekly candles to breadth to
these
inflection
weekly
points.
Are going to look disgusting.
Yeah, go ahead and take it from there.
They get to buy in this in two hours. Yeah, breadth's still bad. There's been nothing. And we even saw it out of China, right? So China was one of these areas that just got hammered early on, along with all the small cap growth stuff. And it had this huge bounce. And that has just completely fallen apart. You remember those days where the Chinese stocks were up 10, 12, 15%, and everyone got so excited. Oh, I'm so smart for buying Alibaba at $100. And look where we're at.
And you could argue the only thing out of there, I shouldn't say the only thing, is just Chinese energy. It's matched.
Yeah, it's been the same thing as the story here. You're right.
But everything else, Chinese tech, Chinese discretionary, definitely not. I mean, not a place to be trying to hide out. Chinese energy has been okay, but
Chinese tech, close to absolute lows, new absolute closing lows.
Yeah, and so you do wonder from a thesis standpoint, because we talk about correlations going to one. Is there a capitulation event coming? Right. On Monday, are we seeing a pretty large gap down in the broad indices to finally get the hands throwing up in the air, the final salvo? Because we've been in a corrective market for over
4 months. Well, yeah, over a year.
I was going to say over a year.
Definitely, again, it goes back to mid-February 2021,
right,
when everything changed. And you can look across every asset and see that. But people only started paying attention this year.
Yeah.
One, because it's finally gotten to the major indices, and two, because their bonds aren't doing anything again today to protect any of it.
Yeah, think about that. So I want to paint this because we've got something like the NASDAQ down 2% today, and bonds are not doing what sometimes they do when that happens, meaning they move up. Like that's a place you go in a risk-off environment, and bonds are anemic. I mean,
and then you're seeing kind of what we referred to earlier. I mean, you're seeing continued strength out of the dollar, which it's like, relative strength against the dollar. Maybe people just want to own dollars. I don't, know.
Well, and it's hard because I know the All-Star Charts crew highlighted this, or JC did, just like that the dollar's been stronger against Europe and Japan, but not necessarily other areas. And that's fair. I mean, I get that. Like the dollar's been weak against the Brazilian real, and that there was a time when we owed Brazilian equities because of that relationship. Now, when we look at it from a trade-weighted basis and the economies of the world, we're talking about the dollar outpacing Europe and Japan. Like these are major economic centers. And so that's good information. And so we want to use that information. And it's notable that that's happening in a market with rising rates. And what's interesting is Kevin highlighted during the Lunch and Learn that if you look at something like a commodity index versus a dollar-weighted index, we broke out of that relationship back in February, March of 2021. So there's definitely a lot of things that have changed since February, March of 2021. We've been in a corrective mode since then, market-wise. Now it's a matter of, do we see the broad indices catch down, which are those big names? Is that a fair summary of where we're at?
Yeah. One thing I'd like to add, it's gotten a little bit of attention. I shared this last night. Strategas pointed this out. But if you look at the US dollar Chinese yuan chart, I think that there's some pretty interesting stuff going on there. So, since this correction has started over the last 3 days.
So are you using CNH or CNY?
CNH.
CNH. USD, so USD, CNH. Okay. Yeah. I mean.
So clearly some devaluing going on there from our friends in China. We'll see how long this lasts and what the overall impact. It looks like if the two are connected, maybe they're not. But if this is something institutions and traders are watching, not a great omen for stocks at least over the short term. It doesn't seem should this continue.
No, completely understood. And so you're just looking at USD, CNH overall and seeing what that relationship has done and what the possible ramifications could be if it continues.
Yeah, just a big moves this week.
Yeah, no, it's fair. Always got to be paying attention to the currency markets. I mean, in the end, these things are priced in that. So it's worth paying attention to.
Well, and the last time we saw a move like this was January 2020. Again, I'm not trying to.
No, I get it. You're saying when you bring up January, that period, you're like, okay, well, does that mean that's happening again? It's fair. I mean, these are things we're market historians. We have to be paying attention to these things.
And then it peaked, I would say. So that relationship peaked on March 23rd, 2020.
Mm-hmm.
Again, it did come back and make one slight higher high, but
so
we'll see.
Let's talk about broadly just breadth in general. We kind of highlighted just the weakness we've seen for many stocks since February, March of 2021. Is that ending? Are there any signs of that ending? I mean, where are we at?
Not really. No, it's been continuing to be abysmal. I mean, we look to areas of strength, right? Like sectors, industries. I mean, it's been pretty thin. in terms of if you're trying to get long anything, and just internal breadth has been, continuing to see, abysmal. If we do get a little thrust here and there, it seems like it's maybe a half a day, and then we don't get to close on it, or, we might get one day and that's about it. So even something, even looking at something like SPY versus like RSP. So you have your cap weighted versus your equal weight, that relationship, we look at like this week, did try to give a few clues, and it continues to kind of give clues, it seems like, for more of like that risk on, risk off behavior.
Within your point being, as that moves lower, that's a risk off.
Right. Yeah. So if you have SPY as the numerator, SPY as the numerator, if we're moving down in that relationship, if you take back like Wednesday, right, big 420 day, markets were, I think that's where we opened up, and we just kind of were hanging out. It wasn't too big of a move either way, if I'm not mistaken. And that relationship, I believe closed at new year to date lows on that ratio. So I don't know if it was, ahead of the curve by a day, but obviously the following sessions, we see kind of the bloodbath, right? So,
yeah, for sure. Kind of speaking of 420 day, we had earnings for Tesla on that day. Price, and it's a major factor, right? Tesla's a larger cap name, and it's held by a lot of different sector ETFs or industry ETFs. Any price reactions out of Tesla that we should be paying attention to?
Yeah, had a big pop, and they sold it, and I guess it's still up from its down from yesterday's open quite a bit, but up from Wednesday's close still.
And at the same spot it was back in October of last year. So another area, there's so many spots where markets have moved sideways and done nothing but chop, with the exception of energy and metals and mining. And now those are seeing some weakness. And so maybe you guys could talk about that, some key inflection points, whether it's for commodities or any of the relationships we look at. It could be price level, it could be absolute, it could be, what are some areas you guys are paying attention to on an absolute basis? And it could be, I'll just open it up. It could be anything. It could be a relationship. It could be an individual indice or ETF. What are some things that...
XLE at $80. Not too shocked that we got rejected there. Pretty harsh. But again, the ascent was also pretty strong.
Can you talk about that? So why not surprised? And what do you mean by the ascent part? What are you talking about?
Well,
there?
big. I mean, $80 on XLE is
it's an important
level.
Yeah,
you're back to 07, 2011, 16, 18. Mm-hmm.
You're just saying $80 is an important behavioral level.
Mm-hmm.
And seeing that pull back. I know one of the bigger stocks in that XLE is CVX, Chevron. And it's unfortunate to see what it's doing the past 2 days, because you basically had a consolidation that broke higher and now has failed with an RSI divergence. And so I don't think we get to be surprised if we see energy cool off for the foreseeable future being, next few weeks, maybe to months, or maybe worse. Maybe, as you pointed out, Ian, correlations go to 1, and now we see everything weak and we get that final flush. I have no idea. Dan, how about you?
Chart.
Go ahead, Ian. No, Ian, go ahead.
I was going to say one chart to put in the breadth category, not to swing back there. But so NYSE advanced decline line.
Okay.
Pretty close to making new lows with the price chart not back to new lows. So pretty
negative,
lethargic. A pretty good new NYSE composite, pretty good look at the average stock. So to see that back where it was in mid-March at its lows.
So it's the the breadth is reaching a new low before the indice, which is a negative divergence. Is that what you're
Yeah. Or I don't know if divergence is,
or just confirming downside.
Just confirming that, if this breaks lower before price does, I mean, that's a pretty good canary that market's going to follow.
Yeah, it's a good point. Seeing breadth weakness like that, I mean, hard to argue with that. So great point on that. How about you, Dan? Price levels, relationships you're looking at that are kind of that you'd like to highlight?
Yeah, some key inflection points really that we're trying to get some information from here is probably in like that XME versus SPX.
Okay, so metals and mining versus S&P 500.
Yep. So we talk about like a cooling off period coming at logical levels, right? These highs that we've seen here the last week or so, bumping into highs not seen since really that beginning of 2017. We look at kind of the range that we've been in, this bigger base and the alpha that we've tried to participate in. This would seem like a logical level where, right, we maybe see some consolidation. What information are we getting from this level that we can adapt to? Healthy consolidation would probably be our scenario number one, right? If we can sideways trend out and maybe establish some better risk parameters there. We'll see.
There's
TBD,
nothing wrong with consolidation. Nothing wrong with that. And speaking of consolidation, we continue to see copper futures and gold futures move in a sideways range. But at the same time, when you look at copper,
another failed move from precious metal miners this week.
Yes.
I mean, and so that's another supposedly risk-off asset that can't get out of its own way.
And I would argue with the risk-on asset metal copper, same thing. Can't get out of its own way. Like, so we have this inflection and moment where gold or copper, neither one wants to take the reins, and it goes back to what you guys have been talking about with correlations go to 1. So are we on the cusp of a capitulation event where they sell everything? We've seen it before. It's what happens near bottoms is they sell everything. Everything gets sold. Bonds, stocks, commodities, it all goes down.
I would also say it's probably not going to be a one day.
Right.
Today, I would not call it. It's going to be like I would assume of Q4 2018. Because, right, we're coming out of it. It's a very similar setup. We're coming out of this sideways consolidation, just like we consolidated in November 2018. And then you get the final flush, just the super painful flush.
Yeah. And it's going to feel like, and the headlines are going to be crazy.
Yep.
And maybe we don't get that. But from a big picture perspective, we are seeing still weakness underneath the surface. We are seeing some big names starting to crack. We are seeing evidence of a thesis where...
What about the semiconductors?
Yeah. Actually, great. Talk about that.
NVIDIA never fixed itself.
And that's a big name within the semiconductor space, and it's following its brother.
Never could get back over. I mean, we talk about September 2021 highs. Talk about that date, just like we talk about February 2021 on a lot of charts, September on a lot of these tech charts, and on the broad indices. Also very important, AMD.
Taiwan Semiconductor.
Never even... Taiwan Semiconductor. I mean, AMD never, it's been weak all month, consolidated for, a few days, but we're back to an AMD where it was September 2020.
Yeah. And how strong can this market be if something like Taiwan Semiconductor, the largest holding in SMH, a semiconductor ETF, confirming that the period of December of 2020, so not 2021, December of 2020, through its breakdown in February of this year.
You've got to assume that SMH follows that.
Correct. I mean, that's a leader. That's like if Microsoft and Apple were to break to the downside, that would be the equivalent. Yep. And so, and I would, we would all argue, I shouldn't say I would argue, we as a team would argue that if you're seeing this type of semiconductor weakness, like your BS and your alarm meters should just be going off. Like, wait a minute. Like how, like semiconductors, which is one of the areas of risk on, just continues to get sold. Well, then we better be in a risk off type stance ourselves. We better own more cash. We better not be participating in these things that are going from upper left to lower right.
Software back to its mid-March lows. I mean, banks continue to just, and we've talked about the weakness. I mean, the weakness in banks, it's been there since the divergence when rates kept going up and banks fell off. That was your big clue that people truly had no interest in really owning banks for a while.
Yeah, and especially if you've got a rising rate environment and we can't get banks to get a grip and get some traction. And I just shared a chart with you guys on our internal string, but here you've got KRE, which looks like it might be giving a kiss goodbye on a rate of trend when we connect the lows from going back to January, February 2021. There's that period again. And now are we seeing just weakness overall, even though we're seeing, because that's a common mantra, like if rates are moving higher, it's good for banks. And Ian, you've highlighted numerous times, it doesn't always have to be like that. Take each chart on its own merit. And rates can move higher and banks can move lower. That's just the reality of the situation.
That's how, and right, that should be a clue of how uninterested people are in owning this stuff.
Yeah. No, it's good. Yeah, it's a good point. And again, that's financials is something you see lead towards the end, like end of a bear market. You see financials lead and they are not leading. Again, more evidence building for was February, March 2021 through now, just a massive distribution period. And we continue to see stocks correct from here. To be determined, right? We don't predict. We have no idea. I mean, we're just open to different scenarios, and that's what you got to be open to. Anything else you guys want to jump on before we get onto our market call with the rest of our teammates?
Yeah. And one other thing maybe that has kind of piqued our interest the last day or so is we've actually seen VIX, so /VX, VIX futures, new highs for the month of April here.
Okay.
For April 22nd, new highs for this month, right? Just for the month here over the last 24 hours. So back into like that 27 area on that May contract. So something kind of interesting there.
Well, I was going to say, even bigger picture, Dan, when you zoom out on a volatility instrument like the VIX, we continue to see higher lows in that instrument going back. I mean, you can argue all the way back to the summer of 2021. I mean, we continue to see volatility increase, and it almost looks like if I were to be a pure technician, a rounded type bottom, that we could see VIX move much higher from here. Am I allowed to say something like that? Are we allowed to use technical analysis on the VIX? Controversial.
I think we can.
Well,
yeah.
The future, I'd argue the futures on the VIX are just like any other futures. So absolutely.
Ian, what do you think?
Yeah, I absolutely. I mean, you look at a chart and there are clearly defined trends. Someone out there is building trends on VIX because I can find a lot of them. Also, I think it's appropriate to use horizontal levels. Probably more important.
Absolutely.
But the only thing I would leave the audience with is, just something that I've been thinking about over the it's gotten real popular again. And it's, always this contrarian indicator that people in research like to bring out.
Oh, I know where you're going.
Is this AAII survey that, people are so bearish and, this is clearly everyone's thrown in the towel. What if everyone's thrown in the towel and they're still not gonna, they sold everything, but they're still not going to buy?
Yeah.
That's very possible too.
That's possible too. Or they're bearish, but they're holding because things haven't happened to cause them to sell. It could be both. You could have sold and they're not willing to buy, or you could not have sold and you could have lied to the survey.
Yeah, you could be bearish and say, every time I fill this out and I say I'm bearish, the market ends up turning around. So I'm going to say I'm bearish, but I'm going to stick with it.
And
I'm going to stick with my portfolio.
And that's the problem with surveys. And I don't mean to pick on Packer fans here, but a common thing that happens around here is fans will take a bet, like a financial bet. And again, we've had talks as a team like this. We don't do sports betting around here, but they will bet that their team will lose, even though they think they will win, because it makes them feel good. So if you answer in a survey that you're bearish, but you have long positions on, it makes you feel good because you're right either way.
Yeah,
cognitive hedge.
Yeah, congrats. Exactly. Exactly. Like a mental hedge. Like, okay, good for you. Mental hedge. You went ahead and won $20 because the Packers lost. It makes you feel good because you got your $20. But at the, and so it's the same thing with surveys. In the end, it's about what are you actually doing. And I don't want to.
I was down 10% this quarter, but I told everyone in that survey that I thought stocks were going down.
Yes, exactly. Like I held on, cool, but in the survey, I responded that I was bearish. So I feel good.
Sure. Be sure to pass that on to your clients.
Exactly.
Let them know how bearish you were in your monthly newsletter.
Yeah, we are.
And then didn't do anything about it in their portfolio.
Exactly. We humans are an interesting bunch. That's for sure. Well, guys, I super appreciate you coming out, spending some time with our clients, providing some education and insights in the current market environment and how we're managing that, how we're managing risk so that we're working in their best interest. Much, much appreciated. With that, we're going to close this podcast down. You guys take it from here. We'll do this again in a week and we'll sign off.
Have a great weekend, everyone.
All right. Thank you, everybody. Have a great weekend.